York. So I feel a strong sense of community with this group. As Diana mentioned, Ellevest is an investment company that was founded to change the way that people and organizations, especially those historically underserved by Wall Street, engage with financial institutions. So we are specifically focused on helping women build generational wealth. You may ask, well, do you let men in? We do have male clients. We love our male clients. As you can imagine, they're enthusiastic and wonderful, but they're, very much also down with the mission. We're also, as a company doing all of this as a team and group of people that don't necessarily always see ourselves in the reflection of some of our country's largest financial institutions, which I think is a big differentiating factor of our team. As Diana mentioned earlier, part of the reason why we shy away from some of these conversations is because it's so deeply personal. So before we get into the specifics of today's discussion, I wanted to start with a personal anecdote and one of my earliest and most vivid memories around money. So I'll take you back to, I was my ripe old age of 8. We'll say I was around 8, and my mom took me to open up my first kid bank account. This was actually a very formative moment for me, both in terms of my mom taking me, I remember her taking me to the bank and sitting there and signing a bunch of stuff. But that account was where I would deposit chore money and lemonade sale proceeds. And the funny thing about that timeline in the, early 1990s is that from an economic perspective, the Fed funds rate, which is kind of the interest rate for the economy, and you may hear about that, and we can talk about what that is in a little bit, but that was around 5%. So it meant that bank savings rates were around 5%. So as a kid, every month I would see that balance grow, and I was astounded by the fact that I had money somewhere and I wasn't doing anything and it was growing. And you received paper statements then, and I would rip open the paper statements and be so excited and astounded. So in many ways, it was not shocking that I went on to study economics and finance in school. In college, I worked for my university's credit union. I ran the member service department, so I fielded kind of any sort of question consideration from members of the credit union, and then entered the investment world about 10 years ago. On the flip side of this, I also saw my mom, the same person who took me to open up my first kid bank account, struggle with the financial piece of my parents' relationship towards the end of their relationship, which in many ways inspired me to literally make it my life's work to help women develop greater agency over their money. So you'll hear that term referenced a lot in our discussion. This piece about agency, it's what I love most about what I do, and we'll talk about what agency means when it comes to money. I share all this to highlight that we all have different experiences with money. It shapes how we approach every conversation today around money, be it personal, professional, romantic. Women, unfortunately, historically don't talk about money enough. So we're going to talk about it tonight. Thank you to everyone who filled out the survey in advance. It was actually really helpful to shape the conversation and what we're going to cover. I'm not sure if everyone saw the results or if it was just me and Diana. So if I were to summarize the results at a high level, I would say that this group is first and foremost split in terms of growing up openly talking about money and talking about money with friends and networks as an adult, which is fairly typical. I would say this group is most interested in learning and talking about investment options beyond traditional stocks and bonds, and is also very interested in what it means to invest for impact. There was also a lot of interest in thinking about a first home, so a primary home, and an investment property. And on the planning front, the group is a little bit split, so we can talk about that, and I want to highlight the importance of that. Diana, did I miss anything?
No, I think you've got it.
Okay, perfect. So we'll move on. These are the high level topics we're going to chat about. So kind of set the stage for women in wealth, talk through some investing basics, what it means to look towards greater portfolio diversification, what it means to invest with impact, and then thoughts as you may be having conversations around finding a financial advisor. Okay. Women in wealth. So before I get into these stats, I have one more story that I want to share with you. It's kind of top of mind because it happened a couple of weeks ago, but I was meeting a woman for the first time over Zoom. She had found Ellevest and wanted to chat through Ellevest, and she was kind of on the other side of the camera. And as we hopped on the Zoom, I could see that she was sort of like physically uncomfortable, like she was fidgeting a bit and she was looking in a number of different directions, and we start chatting, and she stops me, a minute or two in and says, Cam, like, I don't want you to think like something's going on. Like, I'm okay. I actually am just so deeply uncomfortable with talking about money that it makes me feel ill. So you're seeing sort of the physical manifestations of that right now, which I think, I can empathize with. And I think a lot of individuals on this call can empathize with, which is why I do want to provide a preface on where women, especially women in the US, are today, because I think it will complement the broader discussion around where we need to go and the steps to take to foster broader financial wellness. So to go through some of these stats, women in the US today have decision-making control over about $11 trillion, and we exclusively manage about 5 trillion of that. 5 trillion may not be tangible. It's hard to contextualize that. Just for like scope and a broader understanding, 5 trillion is right around the annual GDP of Japan, so the annual output of the Japanese economy. So just contextualizing that number. We're set to inherit a lot of money over our lifetimes, around $30 trillion. And we make a lot of money as a part of our everyday professional lives. And that number is right around 4 trillion. But with all of that said, and this is especially powerful or interesting on Equal Pay Day, but the gender wealth gap for the average woman in the US is 32 cents to every dollar a white man has. When you break out that statistic for Black women and brown women in the US, the wealth gap is actually 1 penny to a white man's dollar, which is truly unacceptable. So when we're talking about wealth, it's important to remember that wealth is different from income or pay. The gender pay gap, as we've all been discussing, reading about, gets a lot more attention, as you can imagine, than the gender wealth gap. But I would argue that the gender wealth gap is actually much more important, because the gender wealth gap expresses how much money women have or keep in comparison to our male counterparts. So there are several things that contribute to the gender wealth gap, but the biggest thing is that women tend to invest less and often later in life. And we typically hold on average about 70% of our wealth in cash. So going back to my story, to me, and I imagine for members of this group, it's kind of no wonder that the woman I had referenced earlier, or why we, sort of like don't feel good about having these conversations. We often take action with a feeling of scarcity and not abundance, and the propensity to think in terms of scarcity, what I have versus what I could have, perpetualizes a lot of broad and, from my perspective, inaccurate generalizations around women and money, right? Like, women are bad with money. Women should save. We should sock our money away. We should not buy the latte, because if we don't buy the latte, we're going to be millionaires. A lot of those narratives. One thing to note is this is despite the research that says that women who work invest 90% of their income back into the health, nutrition, and education of their families and communities. That is a multiple of the statistic for male counterparts. And there's quite a lot of research that says that women are just as good of investors as men, if not better. I will say, from the clients that I work with and the women investors that I work with and those in the industry, women tend to do like a ton of research on the front end. We all know the feeling, like, you know, pulling up our sleeves and really getting into it and making informed decisions, long-term decisions. And the reason why women are often better investors than men is, you know, we don't kind of like pull out at, you know, a sort of sign or shock in the financial markets or in the stock market. So we don't really trade away those gains. We're very much like long-term thoughtful investors. So completely the opposite of what, you know, a lot of the kind of broader narrative will say. So important things to remember, you know, I think in us having this conversation and, you know, Ellevest is a company doing work and so many tremendous companies out there, we're addressing these issues, but it's just like certain things to remember for one's everyday life when there's this feeling of scarcity. Okay, how do I kind of turn this into thoughts around growth and abundance and whatnot? So with that, let's talk about investing and how to grow one's wealth. And Diana, you're watching the chat, right? Because I'm unfortunately not. Okay, good. There we go. Okay. This will sound remedial, but it's super important, especially right now. It's deeply important to know and understand the difference between keeping money in a checking or savings account, you know, like a transactional cash account versus an investment account. I know that it sounds simple, but I just want to contextualize it too. When money sits in a savings account at a bank, the logistics of that transaction is that you're actually effectively providing that bank with deposits. So think of it as you're making a short-term loan to the bank. A bank in their business model has the latitude to lend out some of that money. Maybe it's for individual activities or commercial activities. And as compensation to you, they pay you a modest interest rate to have your money there. The conundrum that exists today, as I think we all know, as we look at our bank statements and saving statements, is that interest rate a bank pays to us is almost as close to zero as we've seen historically. That may be going up soon with kind of interest rates across the economy rising more broadly. But who knows? The bank doesn't necessarily have to kind of pass that along to a consumer. So it's something to think about. I do want to reference the fact and the stat that I mentioned earlier, and that's that women keep 70% of their wealth in a bank account. So the conundrum today is earning nothing while the price of goods and services, you know, typically increases about 3% a year, but in 2022, that number is more like 7 to 8% a year. We're like feeling that inflation very much right now. So the cost of inertia, the cost of doing nothing, the cost of not thinking about investing is not zero. When inflation is rising 8% a year, it's actually, you know, a negative 8%. So I would, you know, as we're hearing more about inflation, as we're talking about inflation, I would think about that, especially if you have some cash that you've been thinking about investing, because that makes the cost of doing nothing that much greater. On the flip side of that, when you invest, you're typically buying, you know, partial ownership of a company or another asset, or maybe you're loaning money to a company or government. This is a very different activity than, you know, putting money in a savings account or lending money to a bank, right? There are inherent risks in those activities when you extend beyond having money in a bank, which is why it's important to reflect on what you're investing for, which we'll get into a bit. Again, I know it sounds remedial, but it's just kind of an important distinction to remember. And one thing to note is that when we are investing, and we'll talk about these various areas and asset classes, but at the end of the day, it's about balancing kind of the risk of the investment with the long-term return and your capacity to take risk and that timeline. So that those decisions and a lot of things factor into that will determine your mix of, how much money you may have invested in stocks, which are public equities, how much money you may have invested in bonds, also known as fixed income, and how much you may have invested either in an alternative asset class. That could be a rental property, that could be a private fund, that could be a digital asset, but that mix will very much depend on your situation. So going to the basics of stocks, a stock at its core is partial ownership in a company. So when you have a part ownership in a company, as long as you own it, you participate in the economics of that company. So it could be the earnings of that company, the cash flow of that company. You also participate in the long-term value that company has to society. And that's kind of the long-term appreciation of that stock, its stock price, and the overall value of the business. I would say that the primary reason why you would own a stock is to earn a return on that investment over time. So if you think about the kind of component piece returns of a stock, first one is appreciation of that stock. So the value of that stock, or the value of that company going up in value. Appreciation is driven by a few different things, right? That company could be growing their earnings. So earnings also being profits. And that could drive, appreciation or increase in value of that company and therefore that stock. Or perhaps there's some dialogue or there's some sentiment across investors that company is inherently kind of has greater value, right? Maybe they are an acquisition target, or maybe they're doing something in their business line or reinvesting money in a certain way and whatnot. But there's a little bit of like actual earnings, and there's a little bit sentiment that tends to drive stock prices both up and down. Another component of the return of a stock, and it's not necessarily always kind of a component of return, but you will see it as what is called a dividend. So dividends are a share of a company's earnings that are paid to shareholders. A company will pay a dividend to basically reward their shareholders for providing them capital to run the business. What you tend to see is earlier stage companies who don't maybe aren't in a cadence of like normal earnings, or companies who are reinvesting a lot of money into their business and growing and acquiring and whatnot, they tend to pay no dividends or low dividends as a percent of their earnings. And you tend to see sort of more of those blue chip companies that have been running for a while, maybe reinvesting less in their business, paying higher dividends. So it's a component return. It's typically not the driving factor of a stock's return, but it does create cash flow for you as an investor, because those dividends are paid out in terms of cash. So for those who are looking to derive some sort of cash flow off their portfolio without having to sell out of anything, it's a strategy to think about. Any questions on stocks? Oh, wait, I see one.
Yeah, I have a question, Cameron.
Yeah.
So I've been watching the market really closely the last few months, and even before the issue of war, there's been a lot of drop, in the stock market. And I personally am just pivoting out of a 30-year corporate career in medical industry, and I'm actually getting into wealth consulting, but I'm doing it through a little bit different products. So I'm very risk averse because I'm much older than you, and my husband and I are closer to retirement. And so, we recently just made a big move of our, retirement money from stocks, which had been set up at a very young age and just never looked at again. And then realizing, wow, that was 99% risk in the stock market. So we moved it to something else that was safer. So I just wonder, what kind of advice you guys are giving people right now, because the stock market is so volatile. And it's a nice idea that, being able to invest in a company and saying you own part of it. But, depending on when you get into that company, you try to buy Apple stock, owning, a little teeny mini fraction of it, right? So, obviously there's smaller investment vehicles, maybe smaller companies where you could actually have an impact on it, like you're saying, sustainable investing and so forth. But I'm just curious where you're leading your clients for investing who, might be older and want something less risky. Like the indexed annuities, I think are really incredible products that I'm learning about and telling my clients about, because that's where we want to put our money, because it's a zero floor and it still does get the upside when the market goes up, but then you never lose. So it's frustrating that, we're always seeing in these two dynamics, right? You're giant risk or you're zero in the bank. And it's like, there is a middle product, but there's just not a lot of conversation around it. But I don't know everything that you consult on. So I was just curious what you recommend.
Yeah, Mia, it's a great question. And it's very much, I call it today very much the income conundrum. And it's not necessarily age-based, like it is for sure a conundrum for those who are either in second career or retired, or even someone who's younger, who's focused and whose lifestyle depends on some component of income from the portfolio. And why I say it's a conundrum is, you have the S&P 500, which is effectively the collection of the largest or the biggest 500 companies in the US. The dividend yield on the S&P is under 2%. It's somewhere between 1.5% and 2%. So you really only have, say you're invested 1.5% to 2% of that coming back to you in terms of cash flow in a low interest rate environment where retirees historically could, be invested in a longer term bond and be making 10%, for very little risk. That's not the case today. And if you're investing in a 10-year US government bond, that's paying, around 2% right now. For our clients, my little ring light went off, which doesn't matter, it's fine. For our clients, where we're subbing some things is in that, and I'll chat about it in a bit, is in that alternative space. So finding areas, whether it's investing in high quality real estate, like real estate fund, where, the underlying real estate, you have the cash flow coming in from, those rent payments being made. So, a big piece of the return is just cash flow and income versus total capital appreciation. We're doing something similar in the renewable energy space, where, you're investing in utility like assets that are paying, 6.5-7% income. But you're right, it's very much a conundrum. Before everything going on in Ukraine, kind of separating that out, a lot of the market volatility that we saw in the beginning of the year was actually related to the fact that people expected interest rates to increase, right? The Federal Reserve, which is the Bank of the United States, has a couple of different mandates in terms of, what they're supposed to do as it relates to the economy. They're supposed to keep inflation in check, and they're supposed to foster kind of full unemployment across the economy. But as as prices have gone up for a host of factors as it relates to the pandemic, supply chains, oil, what's going on in Ukraine, the Fed has indicated that they'd raise rates. And so what's happened is the safe alternative to a lot of things, say a bond that's paying more interest than it did before, becomes compelling to individuals who are looking to their portfolios to generate income versus a high growth stock that, maybe has a lot of potential, but isn't, creating the current earnings that are expected. So it's it's a tough dance. We're having this conversation with all of our clients, but it tends to be a mix. I don't think of it as much as binary, like stocks or no stocks, but it would be kind of decreased stocks, still a prudent amount in fixed income, which, is really sort of the capital preservation piece of your alternative, and then finding those alternative income streams through these private alternative investments.
And remind me, I'm trying to remember my econ from 30 years ago. As interest go up, bond rates go down, right? They're inversely related. Is that right? I can't remember.
I'll correct one thing, but you have the right thing. So as interest rates go up, the value of existing bonds goes down. And so the thought process there is like, let's say I lent money to XYZ Corporation and they're paying me 2% to lend money from me. And then as, interest rates increase in the economy, I realized that I could have lent money to ABC Corporation at 3%, but I'm instead lending to XYZ at 2%. And so kind of the value of that loan has decreased in value because new debt is being issued at higher interest rates. So that's the dynamic. And it's kind of like, it's an inverse relationship, but it's always a little hard to remember. Awesome. Great question. Through me is a great question. We covered a lot of this. I'll cover bond quickly, but
quick question before we move on from stocks.
Yeah.
So if I get restricted stock units from my work, how does that vary from just the stock description that you show here? And as a second question, how should I think about it differently if I haven't vested yet?
Yeah, it's a great question. So restricted stock units for this group are a form of equity compensation, and they should not be ignored or avoided. A lot on the call will know that equity compensation from a company is representing an increased share of individuals, total wealth and wealth building capacity. So restricted stock units are effectively a future promise of your company's stock. So when you get the grant of restricted stock units, which are often called RSUs, it's a grant, but you're not receiving the actual shares. And the receipt of those shares will depend on a number of things. There may be a time component to it, like how long you're at the company. There can be a like company performance metric to it. So how your team does, how your line of business does, how the company does. So there may be sort of one of those parameters around when you receive those shares, or you could actually have multiple parameters. When those parameters are met, you then receive, that stock. That stock is called, it vests, it comes into your account. It's recorded as basically income to you, almost like bonus income to you for tax purposes. And then you can technically do as you see fit with that stock. It's now your stock. Specific companies will have additional parameters around whether you could, immediately trade out of that stock, whatnot. But, for it to be yours is very much related to the grant and the specifics of your stock grant. In terms of how you should think about it, at Ellevest, we have a lot of companies who are in that same position. So we'll model out the grant. To be quite honest, someone's time at a company can be dictated by something like that. So I actually have a number of clients who I work with where, if they're thinking about a career pivot or something else, we're monitoring their vesting schedule and kind of like where we want to get to before they make that pivot. I would say too, from a career pivot perspective, it's important to understand the vesting schedule and where you are and the value of that stock at the time, because let's say you're getting poached for something else, or you're going to go do something else before that stock vests, like that should be a part of your negotiations with your new company, and that value should be incorporated in the kind of price you're being paid, or the cost you're thinking about to move. So it's actually deeply important.
Thank you. It
Yeah.
can be depending on the tool that you have, it can be hard to figure out what you're vesting at different periods.
Oh, they don't make it easy. I know.
Yeah.
They don't make it easy. I'm happy to offline help take a look, but they make those grant documents really, really tough to follow.
Thank you.
Yeah.
Yeah, Cameron, I think in the sake of time, for if we could keep, if it's something very specific to your personal, finance or situation, these questions are great, but maybe let's save those to the end, or up to you, Cameron, but I'll let you know if another question pops up, but I just know that there's a bunch more that you have planned. So
Yeah,
just want to make sure we get there.
It's not too much more. No, the questions are totally fine. And I think a lot of, we've covered some of this, so I'll go through it more quickly, but just to cover bonds who are less familiar, when you're investing in the bonds of a company, and bonds are often interchanged with the term fixed income. So, adding to confusion around investing. But when you invest in the bonds of a company or government, think of it as the equivalent of extending them a loan. So they borrow from you, they pay you interest, and at the end of the term of the loan, they pay you back for the original value of that loan. So when you're investing in fixed income, the goal there is very much to preserve that money that you're investing and effectively lending out, and then earn a little bit of interest along the way. Again, the kind of broad assumption is that interest rates will slowly increase, as will interest that's paid on new bonds being issued. But just something to keep in mind as you're investing in fixed income, this will never be your heroic asset class. For alternatives, the kind of standard definition for alternatives is anything that's not a stock or a bond, which is a terrible definition. I like to think about alternatives in terms of their properties and why I might invest in them on behalf of a client. I like alternatives because their return stream is often not correlated to what's going on in capital markets, equity markets, fixed income markets. Their return stream tends to be like completely different and based on the asset we're investing in. They tend to have properties that return properties that are also a little bit different. So maybe outsized income or outsized total return potential. And some alternatives are also very good hedges against things like inflation, et cetera. So some alternatives we invest in at Ellevest, most of them are through third-party investment managers. So we're investing in their funds on behalf of clients, include real estate. We're doing a lot in the affordable and workforce housing space. We're investing in venture capital, where the majority of the early stage companies that we're investing in are owned and operated by women globally. We also do some private lending to small businesses in the US, actually revenue-based lending. So loans based and tied to a company's revenue, but we take a focus of lending specifically to companies owned and managed by women, minority owners, operators, and members of the LGBTQ community. We're doing a lot in the renewable energy space. So alternatives have kind of like a host of definitions. I would say, the newest alternative or newest kind of area we're talking about, or a lot of clients are asking about, is in the digital asset space, and kind of anything and everything that the blockchain technology underpins. So terrible definition, but this is a big piece of what we do, and is a way to also help weather market volatility. And, in times like today, when, a lot of things are being driven by elements outside of kind of the direct purview of the United States. I will say, if you're just beginning investing, a lot of people will ask about vehicle, like, where should I start? Should I do everything in a taxable portfolio? What should I do? Like, my number one rule is, if you're just starting or trying to ramp up, the best investment vehicle to start in is your 401k or some sort of equivalent. That may be a 403b plan, a solo 401k plan, a SEP IRA plan. I like these saving structures, especially a 401k saving structure. So like an investment plan, because it is work sponsored. So, your employer has to vet the company administrating your 401k in terms of their investment options, their fees, all of that sort of stuff. So it goes through kind of that first check. You can make it automated. So you could contribute, bi-monthly, monthly, in a way where it's kind of like an out of sight, out of mind mentality. You can contribute quite a bit, far more than you can to a traditional IRA plan. It's a tax efficient saving structure. So the amount by which you contribute reduces your taxable income in any given year. And if you're lucky, you may have a company match where your company may match an amount that you contribute to your 401k. So if you're just starting or thinking about starting, I would say that's a great place to start. And I'm happy to answer any questions about kind of next investment steps and next vehicles. No? Okay. Many may know this term, but I want to go back to basics. Compounding in investing is your friend. So Albert Einstein, I believe, was reputed to have said, compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. I would obviously like swap in a she in there, but that's okay. What is compound interest? Compound interest is interest on interest or return on return. What it means in practice, for an example, the US stock market has returned an investor right around 9.8% on average annually from 1928 through 2020. The number 9.8%, doesn't mean a lot to most people. It doesn't sound heroic, meaningful, tangible. But when we go back to this idea of compounding, remember that's a growth rate on a growth rate on a growth rate. So 9.8 on 9.8 on 9.8 from 1928 through 2020. So had you invested $1,000 in the US stock market back in 1928, just as an FYI, that would feel like the equivalent of investing $15,000 in today's dollars. That $1,000 in 1928 would be about 5.5 million today. So not adding to it, not doing anything, just investing, set it and forget it, compounding. So, something to remember as you are investing. The other thing I want to reference, and let me just make sure you guys can see this, is the importance of really not trying to time the market. Timing the market basically means timing your entry point of investing and divesting based on what's going on, sentiment, volatility, et cetera. So I do want to provide an example of two different investors that each have $600 that they can invest over a 6-month period. So on the left, you'll see an investor who takes the approach of timing the market. On the right, you'll see the investor who takes the approach of dollar cost averaging into the market. I'll actually start with the right. So dollar cost averaging is a term that basically means that over time, you're investing around the same amount. You're not really, paying attention to whether it's a up day in the stock market. And I'm going to use the term stock market, but, this could apply to the fixed income markets as well, but more applicable to stock markets. A down day, you're just saying, okay, every month I'm going to invest $100 of that $600. I'm going to do it for 6 months and we'll see what happens. So you can, notate amount invested every month. And, as you see, the market's moved around. It kind of was at one point, it decreased in value, decreased again, went up in value. So this investor basically bought into the market at different price points. At the end of the day, with that $600, purchased 36 shares. And let's just say, for the context of this example, this is the S&P 500 or some equivalent. On the left-hand side, you have an investor who's much more driven by behavioral factors, really trying to time their entry point. So they invest $100 to start when the market is at $50, but get spooked as the market's going down to 25, 20, 10, 10, so is not investing over the course of those months, even though it's a little bit more of a bargain. They invest the balance in June as the kind of market rises to $20. And in terms of total shares purchased, they purchased 27 with that amount. One thing to note is 27 shares at $20 is $540. 36 shares, at $20 is $720. So you can see the value add of being a little bit more disciplined in your approach, not driven by kind of that behavioral component. And that really goes back to the argument of not trying to time the market. Easiest way to do this, I think, a lot of us do this in our retirement plans. Again, a lot of that money is sort of out of sight, out of mind as we're investing in our 401ks, but you can do the very same thing in a taxable portfolio or whatnot. And this goes back to Mia's question and some comments from earlier, so I won't spend a lot of time on this, but in terms of your mix of how you're invested, that will very much depend on what you're solving for, right? Are you solving for cash flow? Are you solving for long-term growth? Is your timeline something that you need to fund in a couple of years? Is it something in 40 years? So there's no one size fits all portfolio, and kind of the mix of these pieces of the pie will very much change based on what you're solving for. And it won't be static, right? These pieces of the pie will change as life happens and things happen. And so that's what we're focused on at Ellevest. And we very much call this goals-based investing. So instead of saying, oh, I'm going to target this rate of return, which is obscure and doesn't take a lot of things into account, it says, hey, I'm actually going to target funding specific goals, and how I define success is my ability to fund these goals, both kind of in the short term and longer term. Okay, lastly, investing for impact. When a lot of people, when I kind of start this conversation with a lot of clients or prospective clients, the initial reaction is, I want to do, well, there are a couple of different reactions. There's, I want to do good with my money, but, I'm afraid that doing good will generate low returns, which I think is kind of like one myth number one. And another perspective, and it's not wrong, is I want to do all of this sort of on one side of the ledger. So invest in a certain way, grow wealth in a certain way. So, at a distinctive point in time, I can give that money away and give it in a way that affects impact from a charitable perspective. With increased data and awareness around companies and policies and assets and environmental considerations and social considerations and gender disparities, we're finding more holes in that argument, as you can imagine. And, we've actually had situations where clients who've taken that approach we've come to realize that what they're invested in, to eventually give away is in direct conflict with what they're funding on the philanthropic side. So it's a super interesting conversation as we're getting more data. But I do want to state that like impact will mean different things to different people. Like I have clients who say, I want to affect impact in the climate and water space, or I'm seeing tremendous issues in broader labor rights, or I'm super interested in data privacy and security. Here, let me go to this next page. How we tend to think about impact and investing for women specifically is that it's broader and deeper than just gender equity. And when you think about a number of sustainability factors that we use to measure companies and or assets, when we're talking about climate, labor rights, security, war, et cetera, like obviously if a company or its policies or procedures are an offender in that space, it's going to affect everyone, right? It's going to affect communities, it's going to affect people broadly. But in most of those situations, it unfortunately affects women disproportionately. So when we're thinking about investing for women, it includes, investing in companies with more women in leadership and on boards and, with greater pay equity, but it really extends to incorporate a lot more sustainability factors. I'll actually pause there because I know this was a highly requested topic and I want to make sure I'm answering any questions.
I have a question, Cameron, about this. Like you mentioned in the beginning, kind of how the myth is that it doesn't do as well or, investing. Is there kind of stats that you can share or something in how well, like, even though investing in impact can mean very, very various things to different people, but kind of just performance wise and what you've seen in your experience?
Yeah, I don't have specific performance stats. What I will say at Ellevest, when we are looking at investment opportunities, we first and foremost say, like, does this investment stand on its own? Like, is the long-term return or expected return commensurate with the risk you're taking and investing in whatever it is? Maybe it's a company or something else. And then after that, it's what accountability can we give to clients around this investment? How can we report back on it? Maybe if it's a company, what's their CO2 emissions? What does their leadership look like? What does their board look like? Have they had any policies that really don't pass muster on what we believe in? So a lot of that kind of return is on the impact side. But what you do see in terms of, like, let's take a impact focused public equity strategy, is a lot of these considerations are actually risk management, right? Like it's not only doing good and funding companies that, are doing good, but it's also weeding out the companies that would have those like left tail risks that would actually have a meaningful impact on that company's performance. Like I think about, I don't know if you all remember, I mean, they've had a big stock drop recently too, but back in 2018, when all the news came out around Facebook and Cambridge Analytica, their stock dropped over 20% in value, erasing billions of dollars of shareholder value. So part of it too, from a return perspective, is trying to kind of like remove those tail situations of companies, really not doing well for shareholders, broader stakeholders. And so eliminating kind of the potential of holding a security or investing in a security that could experience that kind of drop in value as a side effect.
Thank you.
Mm-hmm.
Are there any other questions yeah, there was a lot of interest in this from the surveys, at least.
Okay, well, you all know where to find me.
I actually had a quick question, Cameron.
Yeah.
I couldn't get off mute fast enough, this Marina. I wanted, if you have any information about opportunity zones, investing in opportunity zones?
Mhm.
Speaking about, investing for impact.
Yeah, opportunity zones is a great question and great topic. So back during the tax, I'm not going to get the full kind of act right, but the Tax and Jobs Act, actually under the Trump administration, there was a bipartisan, if you can believe it, act passed focused on getting more money into what's called qualified, opportunity zones in the US. And opportunity zones are effectively identified regions and communities that have historically received less capital and investment to kind of really foster and grow the community. And so as part of this act, these areas were designated as those that could accept sort of new investment, developmental investment. So maybe developing commercial buildings or residential buildings, et cetera. And as kind of a plus or a bonus, or to kind of intrigue investors to invest this space, they said, well, if you invest your capital gains from something, so say you sold a stock that had a very low basis and had embedded capital gains, or you sold an investment property that was going to have a lot of capital gains, you not only defer those gains, but you may be able to kind of increase, have a step up in value for that original asset. So kind of reduce your end taxable bill. And if you invest in that area long enough, the earnings from that investment could be tax-free over time. So it's a really interesting space. The strategies that you see in that space tend to be like hard asset oriented, right? Because it has to be development oriented. So it's like real estate strategies focused on commercial buildings or residential buildings or renewable energy in that space. But it's a really interesting opportunity for investors to, one, not only defer capital gains and potentially earn a rate of return on an investment that's not subject to taxes down the road, but help to develop these identified communities across the United States.
That's great.
Mm-hmm.
Thank you.
Yeah, you're welcome. Great question.
I think Mia is looking for you on LinkedIn.
I tried, but everyone was a man who came up with your name. I was like, Cameron Rogers. There's like 9. I'm like,
I know there are a lot.
that's crazy that you're not coming up. Like,
oh, that's so funny.
That's like the whole problem inherent in this, right?
I know.
Find a woman. It's like, are they hiding us from each other?
I know. Yeah, there's like a fun food blogger named Cameron Rogers, and everyone's like, when did you start your food blog? I was like, what? I don't know. Anyway, sorry, on to the next piece. So this last piece, whenever I'm talking to prospective clients or people thinking about engaging with a financial advisor, I'm of the view, like, give you the questions to ask and kind of the tools to make informed decisions. It's a really opaque space. It's a confusing space. Part of the reason why we exist is because for so many women, there were all of these barriers to entry, or they didn't see like someone they wanted to work with at the other side of the table. So I put together kind of a series of topics and questions that, like, if you are engaging in this conversation, you always want to cover. I'll go over them quickly. And then, Diana, we can circulate this for the group, or I can send this separately. First and foremost is talking about or asking about that person and that company's fiduciary duty. And a fiduciary, basically, if you have a fiduciary duty, your client has to sit at the center of everything you do. So if you're recommending an investment product or an investment strategy or doing something, it has to be in your client's best interest and not in the best interest of the company you work for or for the advisor yourself. I know it sounds very intuitive, but you would be surprised how many advisors and investment platforms out there aren't true fiduciaries. Always ask about fees, ask about what the fee model is. If you are part of a family or have accounts in a couple of places, it's always great to say like, hey, if I, bring more accounts over, bring more money over, are there economies of scale to me as a client of yours? Custody, and asking about a financial advisor's custodian is effectively asking like, okay, if I come on board with you, where will my investments live? So like if, anything happens, like who holds that and who custodies my assets? And, there are big custodians out there. So for example, we custody our clients' investments with Charles Schwab. Always important to ask about your support team, basically your bench. So who's managing my money? How are you managing money? Are you rebalancing portfolios? Are you tax loss harvesting? What is client success? I would also suggest asking about the broader service model, how often you should be reviewing your portfolio with an advisor. If impact's important, and it sounds like it was for the group, ask about how an investment company is helping clients invest sustainably, and also ask about the investment company themselves and what they look like and what they're committed to. And that goes back to that diversity piece, which is the last point. So in terms of what an advisor could help you out with, it could be that diversification piece for stock concentration, going back to the question around equity compensation and RSUs. It could be investment planning. Maybe, as Mia mentioned, your investments are structured in one way, but life's changed or evolved. So you need to think about kind of that next step. Monitoring day-to-day changes in the accounts, financial planning, which is basically providing qualitative and kind of quantitative factors around how you're investing. Tax loss harvesting. I don't know if this group knows the term tax loss harvesting. It's actually super relevant right now. So I'm happy to go through it quickly, but effectively when, and it sounds, anything with a loss never sounds like a good thing, but it's actually a good thing. And it's a really prudent trading and investment tactic. But let's say today, or tomorrow, I bought Coke at $100, and at the end of tomorrow, Coke was worth $80. So I have a loss of $20. Well, I could do a couple of different things. I could, stay invested in Coke at $80, so at a $20 loss, and hope it goes back up. Or I could say, you know what, I'm going to capture that loss, because an investor losses are actually valuable as a taxable investor. And I'm actually, once I sell out of that stock, so capturing a loss means selling out of a stock at a loss. I'm going to capture that loss of $20, and I'm actually going to go and buy Pepsi. And the thought process is Coke and Pepsi may trade kind of the same. So if Coke's down and maybe Pepsi's down, I get to participate in the upside of Pepsi. So what you've done is you've secured an investment loss, and investment losses are actually like little gold nuggets, and you've stayed invested. And investment losses can be used, in the year you took the loss or in future years to offset portfolio gains across your taxable portfolios. So it's a way to stay invested. It's a trading strategy where you can stay invested, capture a loss, and use it to reduce your tax bill in any given year. So as you can imagine, over the last few weeks, the Ellevest team has been pretty busy doing tax loss harvesting in our clients' portfolios. And if I went through that too quickly, because it's a tough topic, I'm happy to talk through it in more detail. We can do more Q&A. The last thing I'll say is, as we have these conversations, and hopefully there are some nuggets of takeaways, is I just think like we as a group need to be prioritizing financial wellness. Financial wellness is not necessarily what you have. It's not necessarily built wealth, but it's knowing what you have, where you want to go, and how you get there. It goes back to this idea of agency. Financial agency is not necessarily like having wealth, but it's actually making your wealth work for you. So hopefully in the remaining amount of time, we can go through Q&A. Again, hopefully some helpful nuggets to, to bring back to your planning. And if there's anything that I didn't cover in enough detail, or if you have questions on, you also know where to find me here.
Great, thank you, Cameron. For Q&A, I have one question here from Randy. On if you're able to, suggest ways to get more comfortable discussing money with your girlfriends, even with people who work in finance, they could be comfortable with financial concepts and investing and whatnot, but could still feel really uncomfortable discussing it outside of work. Randy says she suspects men don't have this issue. Whereas I do think, more commonly women could. So if you have any suggestions for that.
It's a great question. And I agree. It happens all the time. I feel like with our male counterparts, you see someone discussing like negotiations of a professional move or nuances of a stock trade or something they've invested in. I mean, I feel like we all see this kind of in the meme stock era and the digital asset era. I think that for women, it's a fear. I think for women, it's a fear around, not wanting to boast. Like I have friends who, if they're in a relationship where they have a male partner and make more money than their partner, like they won't talk about it. I feel like it's about finding common ground. Where I've actually found common ground with some girlfriends is reviewing investments together. So if we find something that's interesting or meet someone that's interesting, like we'll hop on a call together with that person and talk through it. And I think when that's the case, you're not only helping one another better understand it, and she's asking questions that I'm not thinking about, and I'm asking questions that she's not thinking about, but then you're fostering, that broader dialogue and follow-on dialogue. I also like to think about investing as, it should be interesting, right? Like I say this, and I know it sounds silly, but when you're invested in a company or an alternative asset or whatnot, like it should be fun where you're following the trajectory of that company or asset. So it doesn't necessarily have to be about a dollar value, but just like, hey, like I invested in this company and now I saw an advertisement for them on the subway. I know you guys don't have subways, but something like that, just including it in your everyday life. It's a great question though. It's a hard hurdle.
I think we have a question about Ellevest
specifically.
Oh, good. About, does Ellevest have a minimum investments or net worth requirement for clients?
So the great thing about Ellevest is that we're meeting clients across the continuum of wealth building. So in our membership business, which like any client is charged a monthly membership fee. That fee could be $1, $5, or $9 a month, depending on what you're looking to do. We will invest for that client. They will have access to our community, certain presentations, have access to money coaching, executive coaching, and that's like really geared towards those who are either beginning their investing journey or kind of like moving along their investing journey. When we originally started Ellevest, we never thought that we would have the business that I'm in now, which is our private wealth business. It was always going to focus on kind of first-time investors, but we had a lot of women in our network who had built wealth for a while or come into wealth say like, hey, kind of this traditional service or these traditional, big banks or financial services aren't meeting our needs. We don't see ourselves reflected in them. If you build a private wealth practice, like we'll come on board. And so that's the group that I'm in. And we do have an investment minimum, which is $1 million invested with Ellevest across accounts. And one of the biggest driving reasons for that is we are investing in some of these private alternative investments where clients need to be accredited investors to invest.
And with that, Courtney also added, that Ellevest has great webinars, and actually a lot of like the blogs, even content, that is free, that discuss like how to, talk about, the previous question, like talk about, finances and money with your friends. But yeah, so it sounds like Courtney is a fan already. So.
Oh, good. Thank you, Courtney.
Pretty fan. We have another question from Diana, which I think, so apologize, you probably came in a little later, but if you could rename, it's probably from the link that I had sent. About Cameron, what are your thoughts on actively versus passively managed funds?
That's a great question. So the term actively versus passively managed funds refers to, if you're trying to get a certain market exposure, let's say like for ease that you want to invest in some of the, largest companies in the US, does it make sense to basically just invest in a subset of the largest companies in the US via, say, a mutual fund or ETF? Or does it make sense to find a investment manager or portfolio manager who's saying, okay, like I can do that, but I think I can pick, the companies that are going to have the greatest earnings growth and do the best and whatnot. Unfortunately for active managers, most active managers in US markets have underperformed the benchmark, over the last subset of years, and the benchmark being just like do it more passively and invest in a subset of companies and don't try to pick the winners and losers. I would say when you get into more nuanced spaces, like when you get outside of the US, or maybe when you're looking at companies in emerging markets, a lot of times that's where those active views, to the extent that like someone knows that market and the companies there and the dynamics in those markets, tends to be a good strategy. We at Ellevest, across equities and fixed income, tend to be more passive in nature. Passive strategies also are compelling from a cost perspective and cost control perspective. So we tend to say like, hey, if active management hasn't outperformed and it's more expensive to invest in, how about we invest passively? We'll be active in terms of how we allocate across equities and fixed income and alternatives and whatnot. And I will lastly say, I do think that active management is most kind of prudent and really needs to be present when you're talking about alternative investments. Like if you are investing in private real estate, you need people on the ground with operational expertise, doing the renovations, leasing up the buildings, same thing in the venture capital space, but in traditional equities and fixed income markets, we try to stay more passive in nature.
That's great. Oh, another follow-up question. And it's Christina. Hi, Christina. Christina Robertson. Another question about funds in a 401k. Thoughts on target date funds versus building a weighted portfolio?
I like target date funds. I like target date funds because we all inherently can be like very busy and lose sight of what we're doing and work for companies for a long period of time. And I'll step back for a second, but target date funds are effectively multi-asset funds. So they're investing in both equities and fixed income, and they may invest in public alternatives like a REIT strategy, which is a public real estate strategy. And the way they work is you designate a fund that you think is going to like the timeline is going to coincide with when you retire. So say it's the 2040 fund or 2050 fund. And then as the years go by, the allocation between kind of more risk-oriented assets like stocks and REITs versus fixed income changes, and the nature of the allocation becomes more conservative as you get closer to retirement. The thought process behind that is you want less volatility of, you know, the return stream from that portfolio as you get close to retirement, because in retirement you're drawing on that money. And the downside scenario is if, you know, the value of that portfolio, if it were heavily weighted in equities and you saw an equity downturn, would decrease, and then suddenly you're having to draw on a portfolio that's kind of decreased in value. So I actually really like target date funds. I'm invested in a target date fund in my 401k. So, I think they're a good strategy.
Do we have any more questions? I have one. We have a few more minutes left, so feel free to, you know, turn on your cameras or just, you know, unmute yourselves and ask. We have a you know, nice intimate group now. But I have one, you know, in the survey that we sent out, you know, it asks about digital currencies. And, you know, in general, like, do you have a view on those? Like, does Ellevest have kind of like, you know, a general view on those? Of course, it depends on everyone's risk levels, but I just thought that was interesting, you know.
Yeah, it's a great question. The digital asset space is both super interesting and also kind of as someone, and I think people will be at different levels as someone kind of doing research and stepping in, like slightly frightening. I think that technology, so the technology that underpins a lot of these different spaces that we hear about, whether it's crypto or if it's the NFT space, or if it's decentralized finance or Web3, you know, the technology that underpins a lot of that is blockchain technology. I think that the technology itself is fascinating and has so many applications. And if we think about like crypto and the conversation around crypto, Bitcoin is sort of like one of the first and largest applications of blockchain technology. So, which is why kind of a lot of us first heard about Bitcoin and whatnot. But if you think about anything from, you know, well, step back for a second. I think across all of our jobs and what we do, despite there being parameters and checks and balances and whatnot, like trust finds its way into a lot of what we do, and trust is incorporated in terms of a lot of what we do in financial services, outside of financial services. I think down the road, blockchain technology will like change the nature and the cost and like make trust more efficient in terms of contracts and how things are tracked and whatnot. What's tough from an investment perspective and application perspective is like, how do you play that, right? Like, do you play that in stock markets where big tech companies are acquiring, you know, smaller tech companies that will probably be big players in, you know, the metaverse and gaming and whatnot? Do you play it by investing in coins, Bitcoin, whatnot? So we're doing a lot of work at Ellevest. We don't have any sort of investment offering right now. You know, I would say is if you're exploring, and I don't know if I probably can't give direct investment advice, but as you're exploring, I would explore in a way where you're exploring with as much money as you're willing to lose. This is not a statement about like the long-term application, but there's a lot of buzz out there and just a lot of volatility. And I think certain bubbles forming, but it's a super interesting space. It has a lot of applications. I actually think it has an application in the impact space in terms of removing intermediaries, removing processes that make financial transactions more expensive. I mean, just think about like global global remittance payments, and the number of people who, are paying some sort of intermediary to get money to families and whatnot. So it has a ton of applications. I would just, like, in this current moment, say, as you're applying that across your personal investing, think about it as money that, with a high probability of losing.
Yeah, that makes sense. Any more questions? If not, I think we can call it a night, but don't be shy. Okay. That sounds about it. Thank you so much, Cameron. I know
Yeah,
it's late over
Yeah.
on your side, but for those of you who are still hanging on, we have another wellness event coming up at the end of the month. So please, visit, and you'll hear about it on our emails. But yeah, if you have any more questions, feel free to reach out to Cameron. Thank you so much, Cameron.
Yeah, you're so welcome. It's great
and-
to see everyone.
Yes, yes. And thank you. Thank you for everyone joining us on your Tuesday night. And hopefully everyone, takes charge of their financial and wealth building. So have a good night, everyone.
Awesome. Thanks, everyone.
Bye.
Thank you so much. Good night.
Good night, Mia.